Well, running any company is a matter of teamwork, but I'm responsible for delivering investment performance to shareholders and for making sure that we've got the proper mechanisms in place for choosing and reviewing our managers and keeping an eye on all the other people who provide services for us. We conduct research on a number of available databases to find out managers in the area that we're particularly looking for. Through a process of interviewing, we select a shortlist, and the shortlist is then interviewed by the board, who has the responsibility for appointing them. We then see each manager formally once a year and informally more frequently than that, just to check that they're doing what we appointed them to do. And we also emphasize that we take a long-term view of appointments. We're not trying to pick people who are good for a year or two or a season. In principle, we would love to back people through multiple economic cycles as long as they're still fulfilling what we selected them to do. Well, valuations generally are lower than they were a year ago because last year corporate earnings were growing in most regions and prices fell. I think rather than focusing on valuations per se, we tend to look at where the risks are increasing or decreasing, and several areas where we felt that the risks became over-discounted during the course of last year. The UK is one, because of the lack of visibility over Brexit. Emerging markets were another because of US interest rates rising. Both of those are areas where we've got reasonably significant holdings and where we think we don't know whether the uncertainties are going to resolve themselves in a good way this year, but we think that investors are being paid for taking the risks in those areas by having lower valuations than normal. We use gearing in order to amplify the returns for shareholders, and obviously because you can amplify losses as well as gains, we try and make sure that we have more gearing when we think markets are going to rise than when they're going to fall. And last year it was a disadvantage to be geared, and we were geared. We're approximately 10 or 11% geared, which is around about the level we've maintained over the last year or so. It's working for us in 2019, it held us back last year. But the aim that we have with gearing is to be prudent and also to take a long-term view. You can't predict what markets are going to do in the next month or two. So if you're going to be geared, it's because you think valuations are reasonable and therefore time's on the side of being exposed to those markets. The only way you can grow your dividend over the long term is to invest in companies who are growing the value of their business and also who are willing to distribute the returns to shareholders. And so we depend on the portfolio dividends coming in from our managers in order to be able to pay out for rising dividends to our shareholders. So the two things that drive our dividend payouts to shareholders are the incoming income, and also in a really bumper year you can put a bit of money on one side so that if you hit a recession period you have some reserves put on one side to be able to grow the dividend even in a year when your earnings are not growing. Well, there are a lot of uncertainties around. We've got the Brexit uncertainty, you've got policy uncertainties from the US presidency, you've got issues within Europe which could come to a head with the European elections, but a lot of those are well recognised from discourse over the last 12 months or so. And our assessment is that the main threat to equities would be if you thought that there was going to be an economic recession. Is this the end of the economic cycle? Because then earnings tend to disappoint and the multiple attached to those earnings also goes down. We don't think there is going to be a recession this year or probably next year. It could always happen, but on the basis of what's on the table at the moment, we think the outlook for growth is anemic, mediocre, but positive. And in that environment, we think time is on the side of being exposed to well-managed companies without too much financial gearing and just waiting for the returns to come. Don't bother speculating on what happens in the price in the next 3 months, but hope to be invested for the growth in well-managed companies over time. First of all, I don't think you should ever generalise as between there are high risk and low risk investors at all ends of the age spectrum. There are entrepreneurial 80-year-olds and there are very cautious 21-year-olds. But one point to make is that we are very widely diversified. We have approximately 350 odd holdings spread around a large number of markets and a large number of managers. So your exposure to any one manager or economy or company going wrong is relatively dilute. But we don't want to spend all our time producing something that's so diversified it bores people to tears. So we spend a lot of time trying to choose managers who are enterprising and very selective and have high conviction in the companies that they back, in order that we can, if you like, give a happy compromise of reasonable levels of diversification, but a little bit of excitement in terms of the performance we can deliver. And I think with that in mind, people have then got to choose how it fits into their particular portfolio. And it could be that it fits into a large proportion of somebody very cautious. It could be a base load for somebody a bit more adventurous who likes punting internet stocks. So I think we do aim to provide a one-stop shop vehicle for people who want exposure to global equities.